Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Hans Box. Thanks for being on the show, Hans.
Thanks for having me, Whitney.
Hans is a principal of Box Wilson Equity and a senior director at Old Capital Lending, a top mortgage broker in Texas. As a sponsor, he has created 12 private equity funds with his business partner, together Box Wilson Equity, $30 million in equity placed. Hans has personally been directly involved in acquisition, investment, and management of over $350 million in multifamily and self-storage assets, and has asset managed 3,700 multifamily units and has invested in or had equity in 4,300 multifamily units and 2,000 units of self-storage. Hans, it is incredible to have you on the show and get to meet you. Just talking to you a little bit, your background, it just has put you in a position to be so experienced and have such a wide knowledge base of this business. But I'm going to let you fill that in a little bit for the listeners. But welcome to the show. Give us a little more about your background, and let's jump into your superpower.
Sure. So quick background. I am a CPA by trade. I went to a school here in Texas and got a master's in accounting and did the whole route through the W-2, going to get a job with one of the big four accounting firms at PricewaterhouseCoopers. I was there for a number of years, probably 9 or 10 years. And then right after the Great Recession, I decided to take a risk and get into multifamily. So I went from a basic 6-figure job salary to not much at all, to go partner with another individual in the DFW area to fix his accounting, and his payback to me was he's going to mentor me in multifamily. At the time, I'd already bought rent homes, so I kind of had gotten a flavor of it, but this was the huge step into going full-time into real estate. Worked with him for 2 or 3 years, got invested in a couple of his deals. Long story short, and this is probably where my greatest learning experience ever occurred, is in the first deal I got involved with him, where I put $100,000 of my own money into it, which at the time was basically my net worth. I mean, it was probably a little bit less, but not much. I didn't have much more beyond that. I cashed out my IRA to do it, and got involved with him in that deal. And long story short, he's a good sales guy, but he's not a great operator. And we actually, myself, and now my current business partner, but at the time he was just a fellow investor, got voted in by the other investors to basically take over the deal and kind of take control.
Wow.
Yeah. So, and I was green. I was very green. So I was literally sitting in the upstairs office of a Class C property in Dallas, trying to run the budget and work on getting the thing turned around. We managed to hire a management company that we've been pushing for. And she helped turn it around. So, and at the time, we turned it around in about a year and a half. And when we took it over, we were going to lose money if we sold it. And then when we sold it, we made about a 24% gain, which isn't great when you think about it. But considering we were negative equity, it was a good turn for us. And we sold it for a record price in the submarket at that time. Now, and that was $37,000 a unit, to give you an idea. That deal probably sells for $100,000 a unit right now in Dallas. But it got me started with, number one, I met my business partner, and we synced really well. We worked well together. We're both analytical. He's an engineer. He went to Stanford, Northwestern, so he's way smarter than me. But we worked together well, and it also established a base set of investors that were confident in us after seeing us save their investments. And that's how we got started in the syndication model, because we weren't really planning to work together after that. But then they started asking us, hey, you guys gonna do another deal? And we're like, yeah, maybe. And then we started thinking through it, and it just kind of took off from there.
Nice. So that's an incredible experience. I'm so thankful that it turned out the way that it did. It could have been so much worse.
Yes.
Wow. It's incredible that you took that leap. And I'm sure you received some pushback potentially from family or friends, saying, Hans, what are you thinking? You've done all this work, all this school, all this time invested into this career, right? This corporate career, and I usually ask people, it's made that transition because I know there's listeners that are wanting to do the same thing.
Sure.
What gave you the confidence to do that? How did you handle the pushback or maybe some, negativity from friends or family?
So the reason for it, I know I'll answer your question in two parts. The reason for it is when I saw the recession hit and I saw individuals and employees getting laid off in other industries and other companies. Pricewaterhouse actually didn't lay off anyone. They're very good about keeping talent aboard and then trying to tread water because they don't want to lose talent. It costs a lot of money to get talent back. And so I wasn't really worried at the time about losing my job, but I saw that and I saw the risk that it could happen, if this happened again, and I didn't want to depend on a W-2. And at the time I was married, but no kids and not many obligations. I was living cheaply. So I was like, if I don't do this right now and take this jump, I may, number one, regret it. And number two, I might get golden handcuffs, in the next 5 years and not be able to leave just because you couldn't bring yourself to give up. Once you get to a certain level at those firms, you can make pretty good money, but you're also working 70 hours a week. Right. So I was like, I've got to do it now or I might get stuck. And so that was my main reason for doing it. And as far as pushback, my parents were very supportive. I didn't get much pushback at all. And my wife was very supportive as well. So I'll have to say I didn't have to overcome any pushback. One thing I did have to overcome is she also started law school at the same time and took on debt to do it. And at the same time, I gave up my higher paying job. So it was we suddenly were living, on rice and beans as they would say. So, I literally was unplugging my plasma TV that was in my condo to save on electricity. I was doing everything possible to save money. So that was probably the hardest part of it for a while.
Wow. No, it's incredible. I love hearing stories like that because I know it helps encourage the listener as well that's like approaching that decision, or working through that. It's not easy, that's for sure, but so worth it when you can make it happen like you have. Well, I know, from your background, and I want to get into lending a little bit or the current lending market and situation. But on another note, just from your level of experience as a CPA, but then also you are getting to see so many deals, you're getting to see so many sponsors, how they underwrite, and you've become an expert, no doubt, in underwriting, and analyzing, sponsors deals, as an active operator, but then also as a passive. And I thought you could just speak to, vetting a deal or vetting a sponsor in probably much more detail, than a lot of people for that passive investor that's listening right now.
Sure. Good question. There's a lot to vetting these deals, and I'm going to speak multifamily. That's what we're speaking, but this can really be applied to any commercial real estate investment. There's quite a few things. I mean, number one, you have to understand general terms like cap rates, what a waterfall is, what a pref is, a preferred return is, things like that. And once you get that base knowledge, which you can get on the internet in half a day, I think the number one thing you have to do is you need to be able to vet the sponsor. To me, the jockey, as you'd put it, is the most important part of a deal. A good sponsor can turn a bad deal into a good deal, and a bad sponsor can buy a great deal and destroy it. I've seen it happen. In fact, I was in one, obviously. So I think vetting the sponsor is number one. And one of the biggest things I look for with a sponsor is transparency. I tend to ask a lot of questions about the deal just to make sure I understand that what their goals are and their strategy is. And the sponsors that I feel most comfortable investing with are the ones that answer my questions fully and don't try to get around it or are brief in their response. They give me a comprehensive answer, and that will actually share their pro forma with me. I'll be honest, I've had sponsors that I thought were pretty good, but they wouldn't share their pro forma, so I could really dive into the numbers and see how everything was calculating, because they told me it was proprietary. I'm like, it's an Excel spreadsheet for a multifamily deal. There's nothing proprietary about about an underwriting for a deal. So I think your listeners should just look for sponsors that are open, transparent, answer your questions, aren't offended by your questions, because that's what we do with we have quite a few investors that dig in pretty deep to our deals, and we answer every question. We jump on the phone if we need to, and we make sure that they understand what they're getting into. Another important thing with a sponsor is you need to make sure that they can articulate the true value add component of the deal. If there's not a value add component, you shouldn't be investing in the deal. There always should be a value add component. I don't like the term yield play. There needs to be that margin of safety between what you bought it at and the equity you can force to protect your investment. And so always look for a value add component and have the sponsor clearly articulate that. But that's probably the most important thing about vetting a deal. I mean, I could certainly get into the legal stuff. I mean, sure. I also can get very detailed into the operating agreements and stuff like that.
Yeah, let's jump into what you just said a little bit further there. I know like transparency, I ask a lot of people, first or the most important thing to them, or, when working with a sponsor, and, the top things like communication, right? Transparency. Yeah. They want to know what's going on. No doubt about it. What's a way about the communication? And you did highlight some things there as far as asking questions, and maybe you can even bring out a few questions that you ask just in seeing how transparent an operator is, or even the passive investor right now that's listening that probably doesn't have the underwriting experience that you do. Let's talk about that a minute. What are a couple things they could ask just to get a feel for how transparent the operator's being, if they don't have the experience, obviously underwriting like you do?
Yeah. The first one I would ask is really ask them to basically jump on the phone with you or via email, clearly articulate the margin of safety and the value add component there. Another good question I always ask is, what is your downside scenario on this deal? A lot of sponsors, and this is something we include a lot, and it's not, this isn't technical. You just want to know what's worst case scenario, and at what occupancy, say, and at what collections could I conceptually lose? We could break even, or we couldn't pay our debt, because that's where your capital becomes at risk. So what I typically want to see with a lot of sponsors is some sort of a scenario analysis where you have a downside, maybe, and a target and an upside, and then there's certain knobs within those that you turn to see. So downside. We lower our expectation on rents, lower expectations on occupancy, increase the exit cap, and say here in Texas, property taxes are a very big factor. Maybe you are very conservative on your property taxes. So this is not Armageddon, but this is the reasonable downside scenario, right? That's what I want to see. Yeah. And then you want to see a target, and then you want to see an upside. And so sponsors should be able to provide that. I think that plus the value add are a good starting point for somebody that's new.
I like that. And I would hope that sponsor has already played out that downside scenario right before that phone call. No doubt about it. No, that's great information. And so vetting the sponsor, yes, first and foremost, any deal specifics that you can share that would help you to, eliminate whether it's the correct deal for you or not.
Yeah. Two things that come to mind, just off the top of my head. One is this is personal preference. Some people disagree, but I really must have a preferred return first. So as an investor, I don't want to go in a deal where every dollar of cash flow is immediately split, say 80-20 or 70-30 with a sponsor. I want to get a preferred rate of return, whatever that is. And that can be different amounts depending on the type of deal or type of asset class we're in. But say an 8% preferred return, meaning I want to get paid 8% on my investment before the sponsor shares in cash flow. So that's important to me. Fees. I always look at fees and see how see if those are aligned with the investors. There's certain rules of thumb on fees, and if just one quick example is an acquisition fee. Typically, it's around 1%, but I've seen as high as 2%, which to me is extremely high. And what really should happen is on some of these bigger deals that are $50 million, $60 million deals, they're still charging a 1 or 1.5% acquisition fee. it doesn't take any more work to buy a $50 million deal than it does take a $10 million deal. It's the same math. You just add zeros. So they shouldn't be making, $600,000 on a deal. And then if it was a $10 million deal, they're making 100, right? So there needs to be a cap. As you get bigger, there needs to be a cap on absolute amount of acquisition fee. And I kind of, just test it out. When I look at a deal, I don't have a rule of thumb. It's just, does this make sense for the deal and everything else? The other thing is, the one thing I want to stress all passive investors to look at is the operating agreement and how the distributions are done. I have seen some agreements where they actually how do I say this? And this may getting too deep into the weeds here, but on a sale, they just distribute all proceeds, say 80-20. But it needs to have in there, receive your capital back first before you do the 80-20 split. And I've literally seen company agreements where they don't. So I would stress looking for that for your passive investors.
That's a great tip of advice right there. I would definitely ask the operator that for sure before I invested.
Yeah.
Awesome. No, that's really good. Right now, Hans, as a passive investor, what's your preference on the class, an asset class, in the class of property that you're investing in?
Mm-hmm. Well, if you ask me just to pick one, it would be industrial right now. I think, with the rise of e-commerce that was occurring already, and then of course, COVID has made e-commerce even more important. Distribution per square foot is actually, I think it's 1.5 times if it's e-commerce as compared to retail, like sticks and mortar and sticks. So, it was already being increased, the need for industrial. And so I think industrial, either buying existing or investing, with developers is something to look for. I'm actually looking for that myself. And then, there's nothing wrong with multifamily. I think it's hard to find deals right now because everybody's looking for multifamily, but housing's never going away. Mobile home parks, that to me is a good area to be in because we're not really building any more mobile home parks, or very few. And affordable housing is a huge issue. RV parks, I've never invested, so I'm completely newbie in that area, but I've heard some good things about RV parks, and you can't find an RV to buy. So people are I really think that may be a good place to go for somebody that's looking to start anew and dive deep into the details.
Hans, what's been the hardest part of the syndication business for you?
The hardest part is the responsibility you take on with investors' money. I've done enough deals where there's been times where our deal wasn't going the exact direction we thought it would. All of them actually have done well, and we've met pro forma so far, but there's always, twists and turns in the road. And those times are the hardest part for me because we have some investors, including, a few widows, where their husband started investing with us and they have passed, and literally they depend on us for finding deals, and they invest with us for cash flow. And that's a lot of responsibility. And so I think that's the hardest part is when you have a deal that's not quite going exactly how you want, you just, you wake up at night thinking, oh God, we gotta fix this because we have a lot of people depending on us. So that's the hardest part. And a lot of people don't realize that when they get into syndications. The rest of it is project management and knowing how to run a business, really. And if you can do that, then, you can be a syndicator.
How do you prepare for a potential downturn, or like to see even an operator, being prepared as you're going to invest passively?
That goes back to our prior conversation, margin of safety. That's why I won't buy a deal that doesn't have it. If there's not a large enough margin of safety and forced equity I can put into a deal, then we won't buy it, because any downturn or any loss of occupancy or income starts cutting right into your equity. You have a very low margin because your equity is the first thing you lose, right? The debt's at 75%. You're the 25% on the top that starts getting haircut if valuation goes down. So margin of safety, number one, and then the scenario analysis. I want to see your downside there. And if the downside is for instance, in our deals, if we run a downside and we can't end up at least at a 9 or 10 IRR, then we won't do the deal. Even if the target looks great, we won't do that, because that means we're getting way too razor thin on our downside scenario. And it's just not worth the risk.
What do you predict, happening just in the real estate market, over the next, say, 6 to 12 months?
That's a loaded question, right?
We know you have the answer.
And not necessarily the correct one. That's tough. I think there's going to be some distress. I keep, thinking that it'll start showing its head, but it hasn't yet. I don't think it will until these forbearance agreements have started to expire. But I think in 2021, we will see some distress in multifamily and some of these deals that people have been buying that are just razor thin and had no margin for error. Although I don't think it's going to be anywhere close to 2008. This is pending there's not some other black swan event between now and then, right? It's pending that we have a normal election. Nothing crazy happens in the world. We don't have a huge resurgence of COVID or some other pandemic. But I think there will be some distress. I think the distress in office is a bit overblown. I'm actually invested in quite a bit of office stuff with a very experienced owner operator. And there are some facets of office that I think they're going to have issues, especially the ones in the high rise downtown maybe. But I don't think the flight to work from home is near what it's a lot of people have been saying. I've been seeing anecdotal evidence and articles, et cetera, that people are already getting tired of working from home. It's not as efficient. And then the deals I'm invested in, the companies that just signed, like, I think over 100,000 square foot of office space in the deal I'm in, are bringing their entire workforce back to work on October 1st. Entire workforce. So I think that's a little overblown. And then mobile home parks, I think, are a great, I guess, kind of like a hedge against what's going on. They're always going to be needed. So I think that's a good area to get into. And self-storage. It's just that self-storage cap rates have gotten so low that it's hard to find a good deal like multifamily, but it's always going to be needed and be there.
What about just giving us a quick update on the lending market right now, and what you foresee in lending over the next 6 months as well, as an operator, what we should be preparing for?
I think interest rates aren't going anywhere, as we all know, based on some of the Fed's what the Fed has said. So I don't think interest rates are an issue. Honestly, a lot of our borrowers are looking at floating rate loans because you can buy interest rate caps on these deals for minor cost, and it gives you flexibility. There's no prepayment penalty. There's only a 1% exit prepay, and it's only for a year. So that's sometimes a good option for our borrowers to go if they're going to thinking about flipping the deal in 2 to 3 years. In terms of escrows, unfortunately, both the agencies, Fannie and Freddie, are still forcing principal and interest escrows for basically 12 months. There are some cases where it's only 6, and there's some cases where it's 18. But for rule of thumb, it's still a 1 year's worth of principal and interest reserve on agency loans, on acquisitions, and refinances. So even if you own the deal and you refinance into a Freddie deal, which I'm doing right now with a borrower of mine here in Austin, he still was forced to reserve 12 months of P&I until certain guidelines are met or the COVID scare winds down and Fannie and Freddie decide to let go of it. So it's still your money. It's just sitting there. They're just holding it in case you get in any kind of trouble due to COVID. So, that's kind of a high level summary of where we are now. And I don't see rates changing. I really don't. And lenders want to lend. It's just finding good deals. The LTVs are here in Austin aren't great because the cap rates are so low, but you get out into more of the tertiary markets, we're still getting to 75, 80% loan to value on multifamily stuff.
Nice. Well, I'm just grateful for the update. I know there's a lot of operators that listen as well, and just would love to hear your opinion on that. So grateful for that. Hans, I feel like anybody that has success in business has a high level of self-discipline, and you definitely have that. How did you gain a high level of self-discipline?
This is my upbringing. I went to a small school, but my parents were always pushing me on grades, so I was very conscientious in terms of my homework. I was not the smartest kid in our school by any stretch. In fact, there was a guy that graduated behind me that was like state champion in university interscholastic league in math or something. I mean, the guy was brilliant, but I beat him. I was valedictorian of a very small school, so it's not that big of an accomplishment. But it forced me to work hard, and so I kind of just carried that over into my college years. Same thing. Obviously, much tougher at a much bigger school, at Texas A&M, and it just carried over from there. And that's probably part of the reason I chose to become a CPA. It's all about being detailed and analytical. So and it has translated well in my syndication and lending business.
Are there a couple daily habits that you have that have helped you achieve success?
I think number one, and I don't know if it's daily, but I concentrate on growth. So I'm always listening to podcasts like yours and others in real estate and business, not just real estate. I branch out and to get into deeper, business kind of podcasts and then reading books and just trying to learn. And it doesn't have to be strictly real estate, strictly multifamily. I think if you concentrate on growth and getting around a network of like individuals that will push you, I think that's huge. And that's what you need to concentrate on a daily basis.
Knowing what you know now, what would you have done different on your first syndication?
Well, I wouldn't invest with him, right? But at the same time, it actually got me to where I am. I don't have any idea where I would be if I hadn't invested with him and done and basically my feet were put to the fire and I had to learn suddenly, and it forced me to learn. So, I don't know. I mean, knowing what I know now, I wouldn't invest there, obviously. And that's what's kind of guided a lot of my passive investment rules that I've created for myself. But, going back and not knowing what I know now, I'm glad I invested because it forced me to get into the business, fully. So.
What's a way you've recently improved your business that we could apply to ours?
That's a good question. Probably I think one thing that helped us with COVID is it forced us to, we always look at our P&Ls in very detailed manner on a monthly basis. And any questions, we'll send a full bullet point list to our management companies about things that we either don't understand or don't like. It forced us to dive even deeper. Where can we cut expenses? So when COVID hit, we did more of a deep dive into expenses into our various properties and deals and really tighten that up. So that was one experience through COVID. And I thought we were already doing pretty well at that, but you can always tighten the screws a little bit more. And that's probably been our best move through this. We suspended distributions in a few deals. We didn't have to, but we did to conserve cash. And now what's great is we have that cash sitting there, and now we're back to sending full distributions to our investors. So we have a little bit more margin of safety built in terms of cash.
What's your best source for meeting new investors right now?
Well, I mean, obviously coming on a podcast like yours is a great area to do it. Before COVID hit, I went to quite a few meetups here in Austin, where I live. And I've met quite a few investors via that. And then honestly, a lot of it has been organic word of mouth from our current set of investors based on our performance. Mm-hmm. To me, that's the easiest way to grow is just do what you say you're going to do, and it'll grow from there. And that's actually one point I wanted to make that I meant to say earlier is a lot of, your listeners may be new to real estate or new to syndications. And a lot of people overestimate what they can do in a year, but underestimate what they can do in 5 or 10 years. So don't feel like everything has to happen now. Take it slow, take it calculated, think through your goals. and you won't recognize where you are in the next 5 to 10 years. 10 years ago, I would never thought I could be where I am now. And there's no way I could have really perceived it. So I just kept doing, it's about hitting singles and doubles. If you want a baseball analogy, don't swing for the fences, just singles and doubles. You'll get there.
Being consistent. Yeah, I can relate to that 100%. That's great advice. What's the number one thing that's contributed to your success? Maybe we just mentioned it.
Well, probably in some ways it's held me back, but in some ways it's molded me and made me who I am is my risk mitigation. I really think, if you lose money in a deal, here's an example. You invest 100 grand and you lose 50 grand because you just rushed into it. You didn't, whether that's you're the sponsor or the passive investor, and you lose 50 grand. Well, now you only have 50 grand left. Now you have to make 100% return on that 50 grand just to get back to even. So, as Warren Buffett says, rule number 1, don't lose money. And then rule number 2, remember rule number 1, right? So I really think risk mitigation has probably been the biggest single, that and continued growth and learning.
How do you like to give back?
A lot of that is through my fellow investors and people I meet. I spend a lot of time helping people look at deals. I spend a lot of time coaching people just on the side that have become friends. And to me, that that's a great way to give back, or it makes me feel good because I know they're not getting taken advantage of, or they're not losing money in deals, or they have a lower risk of losing money. So I spend a lot of time working with my acquaintances here in Austin and in Texas in general, helping them out if needed.
Nice. Hans, a great show. I'm grateful for your time and just going through the leap that you took in the very beginning and investing $100,000, how you almost lost it, but how that was a crucial step to getting where you're at now and how you turned that deal around, and just your experience now and sharing how you vet the sponsor and the deal, and just even your preference right now of investing and updating on lending. You have such a great experience, and I'm grateful for you sharing that with us today. How can the listeners get in touch with you and learn more about you?
Sure. So my name is Hans, Hans, last name Box, Box. I can be reached at hbox at oldcapitallending.com or at hbox at boxwilson.com. Either one. One is my lending business. One is my syndication business. And my phone number is 214-641-6309. And I'm happy to meet anybody. I'm also on LinkedIn and Facebook, so you can search that. My name's pretty not common, so you can probably find me on LinkedIn too.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.